Good afternoon, ladies and gentlemen. Welcome to today's webinar. My name is Peter Oberlechner, and I'm a partner with the real estate team of Theiss. And I'm delighted to be able to welcome as an outside expert my friend Gergi Juhas. Gergi is currently sitting in our Prague office. Hello, Gergi.
Hello.
Gergi has a very interesting past and present. Gergi is an international transaction lawyer. He had been working with leading international firms and had been working on various continents. And Gergi is also an expert in the insurance business. Gergi had been, for instance, working with AIG in London for a number of years. At the moment, Gergi has his own shop, a company named RFB Consulting. Maybe, Gergi, you describe a little bit what you are doing there and what you're specialized in doing with this company.
Thank you, Peter. First of all, for the invitation to this webinar. I am honored to be a speaker with together with the prestigious law firm of Theiss. And thank you for the introduction as well. I am indeed a transactional lawyer. I was doing both corporate and real estate M&A as a lawyer in and out of the legal and the insurance sector. I was probably the first lawyer from Central and Eastern Europe who worked in London on the global W&I market as an underwriter. And I have been following the market and started off as an independent advisor and broker of W&I insurances. And the organization that I manage is called Risk Finance Brokers. It's a consulting entity, so this is basically doing the advisory part on transactions. And when it comes to broking, we have an exclusive global partner called Ulysses, which is a Lloyd's of London broker, and we are integrated into Ulysses for the placement of insurances. But the advisory aspect of W&I is so important and takes so much time that it's basically two functions in one. And what I do at the moment is doing W&I insurances in Central and Eastern Europe. We have been doing this for about 4 years now, and this means that we are both active in corporate and real estate M&A. We had the pleasure in the past to connect with you on real estate deals, and we worked together on a number of projects. And I think just winding down this introduction, I think the purpose of this seminar is to invite stakeholders of the real estate industry and explain a little bit about what we do in W&I insurance, how it connects to other lines of insurances, and what is the purpose of insurance placement in the context of transactions.
Right. So, thank you. This brings us to the topic of today's webinar that is headed Warranty and Indemnity Insurance in Real Estate Transactions. Now, the product of W&I is altogether not a new one. As some of you may know, it had been developed in the 80s, in the 1980s in London in context with Lloyd's policies. It had become increasingly popular the further it developed in the Anglo-Saxon world in the context of M&A transactions. It has then spilled over, I would say, to continental Europe and is frequently employed and used in M&A transactions in Western Europe. I just saw recent statistics about deals that are insured in Germany and the percentage seems to be higher than 50% of all M&A transactions where W&I has already been taken out. And the interesting thing is that W&I has also made its way to Central and Eastern Europe. That's the region that you spoke about, Gergi, and that you are very familiar with, and is now increasingly employed also in Central and Eastern Europe. Now, we will basically switch forth and back between talking about general aspects of W&I, of course, but we will try to point out and to flag its specific significance the product can have for in the context of real estate transactions, be it transactions in the way of share deals, or also, and that's maybe something that distinguishes it from several M&A transactions, also in the context of M&A of asset deals. Now, to maybe hand over the word to you again, Gergi. W&I is not an isolated product, of course, in the entire insurance world. It is complemented by other types of insurance that have to be looked at in the context of transactions. Maybe this brings us to your first slides.
Yes, that is correct, Peter, and thank you so much for this introduction and start. As we discussed when we prepared for this seminar, I think we rather start the presentation from the transactional perspective. So we are not coming from a legal perspective. We are not coming from a pure insurance perspective. We look at the actual takeover situation, where we have a seller or various sellers, we have a buyer, and in any transaction, there is a process to be followed. There should be a due diligence, there should be a data room, there are commercial agreements, there's a legal framework that has to be adhered to, and of course there is the core of the core material of the takeover, the purchase agreement, which contains the warranties that ideally reflect the due diligence findings and give the details of the asset as well as the details of the transaction. As we are, both you and I, Peter, we are both lawyers. We know that how painful or sometimes difficult it can be to put an SPA in place. So, and even with the best intentions, there are situations where lawyers cannot really put a legal category on certain aspects. And this is how the insurance market has been approached at the start of development of W&I. There were certain questions that couldn't be handled purely in a legal way. They couldn't be reflected in the commercial negotiations, and the insurance market was ready to take over these risks or look into it. And this has developed into the W&I market. But the insurance market, of course, does not only look at the actual takeovers. We can service the buyers and the clients with the ongoing insurance risk management, and there's always a preparation for the next transaction when we are structuring the asset for a sale, and we start working with the so-called sale to buy flip. So this is an ongoing advisory engagement, just like a lawyer would work on a transaction and do the maintenance as well, the corporate or asset maintenance from a legal perspective. Now, the problems that I mentioned and which we think cannot really be mirrored by purely a legal solution relate to a breach of contractual warranties, a financial loss due to defects to a title to a property, or there are certain special situations which are related especially to the target, either in the case of an asset deal or a share deal. And there are various existing insurance products that can be applied to these categories, which can wrap a certain target so that the takeover is supported by insurance and the risks are appropriately managed. These insurances can be called legal indemnities insurances because we insure the consequences of a breach of a contract or a defect in a legal ownership. And these are relatively new compared to traditional lines of insurances. As we know, marine and travel insurance and health insurance and life and non-life categories have been around for centuries. On the other hand, these type of legal indemnities have really just started to grow in the second half of the 2000s globally. And the insurance market is looking at these legal indemnities from an insurance perspective. So, the solutions can bridge differences between common law and civil law approach. The underwriters come from various legal backgrounds, and by these days, whereas these concepts are still applied mainly in the developed world, we can easily find solutions, insurance solutions to be applied for in the second world. So that is emerging markets. That is just to say that these concepts can apply outside of a jurisdiction. For example, it can be easily possible that we look at a deal in a non-EU country and we insure it with under a European law. So there is a matrix of solutions available here, and it does not necessarily reflect the country where the asset is located in, because that is an advantage here. We can take the risk out of the country, we can reduce the country risk, we can reduce the legal forum risk, so clients don't have to go through the traditional justice system, they can liaise with an insurance company. And one of the important aspects of insurance in general is that it can decrease the cost of financing. So in a lot of insurance products have benefits of providing for better financing terms or even reduced cost of financing. So this is also an aspect that has to be taken account when we apply either title, W&I, or special situation insurance. Now, what we are trying to do here is, I was trying to give this background from a transactional and general market and conceptual perspective. But if anyone has questions, please never hesitate to ask. And also, Peter, please, if you have any questions for this few in relation to these few introduction slides, please.
Yes. No. Clearly, thank you. We want to encourage, of course, all listeners, all viewers, to use their chat function to raise any questions they may have. Now, title insurance is of course, a special animal, I would say, that is of high relevance for real estate related matters in all jurisdictions where the land register does not offer the same, I would say, level of protection, of legal safeguards as it does in other countries. So in this respect, I think it's very important to also mention title insurance in the context of W&I insurance, even though, and I think, Gergi, you will come to a slide later on where you flag the differences. I would say for the purposes of a legal system like the Austrian law or German law, whatever, it's customary to also deal with title aspects in relation relating to the legal relationship between the parties in a W&I policy, right? Of course, one of the fundamental differences is, and that's clear on the slide, with title insurance, you can cover 100% of the potential damage, I would say, loss. Whereas under W&I insurance, customarily, also title, when it is insured, is insured up to the cap of the fundamental insurances, which hardly ever will be 100%. Maybe to kind of flag some aspects that you had mentioned with respect of what use it has and can have to take out insurance. According to our experience as lawyers working in a law firm as advisor to either seller or buyer, of course, the discussion about warranties is always one of the critical points of a contract where much time is lost and where there is much argument. To consider to take out W&I insurance is our experience takes out some of the heat that there is usually on this topic. It helps to shorten the process. And I think it also, by transferring the risk maybe to an outside neutral party, helps to kind of smoothen some of the animosities that may otherwise have risen between the parties in a heated discussion about warranties from a very practical viewpoint. So the practical, I would say, the practical recommendation would be to consider all types of insurance, possible insurance to a transaction at an early point of time, not to wait until negotiations have ended at some point of deadlock between the parties. Because as we will be seeing afterwards, to take out W&I insurance requires a higher level of due diligence, both on the level of the seller as well as on the level of disclosure of the buyer. Otherwise, it will not be possible to insure certain risks. So I think so far to this point of time, early point of time in a transaction, knowing about what insurances there can be, think of them at an early point of the transaction. But maybe we move on to speak of warranties and indemnities and of this kind of special type of insurance at this point of time.
Yes, thank you. So thank you for complementing my brief introduction on the subject. I would agree that knowledge of availability of insurances to transactions will definitely can definitely help an early decision on whether or not insurance shall be taken out for a particular deal. Now, if we get closer to the subject of today's presentation, understanding W&I insurance is helpful to understand whether or not it applies to a deal. So very briefly, whereas title is usually related to the actual asset, W&I is more about the parties involved. What are their intentions and how they want to do the deal? A seller may want to get a clean exit, so they don't want to retain any liabilities in relation to a transaction, whereas a buyer always wants to have a good post-closing protection level. So this is what W&I insurance is about. It attaches to the SPA, sale and purchase agreement or asset purchase agreement relating to an M&A process, which contains the warranties. The warranties are statements of fact about the target business, and they have the legal relevance that they protect the buyer in two primary ways. There's an information aspect, because, for example, if we talk about a real estate deal, then the intellectual property aspects of a piece of land or a brownfield site might not be that prevalent as in the sale of an IT company. So for real estate, the information that is reflected in the warranties are primarily related to the actual real estate. And any warranties which are not relevant shall be wiped out during the negotiations. Now, in addition to being informative about the deal, the warranties also give the buyer a right to bring a claim against the seller after the transaction closed. So the warranties basically provide the basis for a claims mechanism that can keep the seller on the hook for many years after the closing of the transaction. And this is where the rationale of insurance comes in, because by means of the underwriting process, we transfer the risk from the seller itself to the insurance company, while also giving the benefit of more flexibility to the buyer. So when I say we keep the seller on the hook with the warranties, we are usually talking about 2 years for non-tax warranties, 7 years for tax, and 10 years for fundamental warranties, which can correspond to title insurance.
Which is I think, just to maybe briefly jump in at this point, this is of specific relevance, for instance, for an institutional seller who maybe wants to close a fund after selling the last asset out of a fund, or sale out of a special purpose vehicle where the proceeds of the sales shall be dispersed basically after the sale of the real estate. In this respect, to take out insurance and to insure the transaction, this gives the seller the possibility to disperse funds earlier than he otherwise would have been, or to avoid the discussion what security should remain in place once the funds of the sale have been disseminated to shareholders, to investors, whatsoever. Last not least, also, of course, situations where a seller would be reluctant to give warranties at all in the course of a transaction, such as, for instance, an insolvency or bankruptcy administrator that would, of course, give no warranties regarding in an auction process regarding the transaction. In this context, W&I would be a possibility for an acquirer to still get warranties at all that have a certain value, where otherwise no such value would be given by the bankruptcy or insolvency administrator. So these are interesting fields of application of the product.
Yes, Peter, thank you again. You summarized it very clearly. The market for W&I has indeed been driven by the private equity industry, which has been, growing in the past 20 years astronomically in the global economy. So with the growth of the private equity industry, the use of this insurance has also become more prevalent for the said reasons. Now, in Central and Eastern Europe, we are all a little bit between two worlds. I think a lot of transactions are reflecting global standards, but on the other hand, the economical framework is slightly different. Investors have to deal with more cross-border questions, and some of the local markets are relatively small, whereas the region as a whole is still very attractive, partly for the legal security of that is given here of the countries which investors can count on. Now, against this background, we have seen a lot of increase in the use of W&I. 10 years ago, there were a handful of mainly private equity investors who used the product, whereas now it has also become applicable in the applicable for strategic investors. We see a lot of local companies who use the product when they invest abroad. So the use of W&I has become more prevalent in both corporate and real estate deals. However, real estate keeps to be a key driver of the product. I think with the use of title insurance, the real estate industry has become more familiar with insuring transactions, and that gives a very good background for W&I. As you mentioned, on an investor level, the main drivers for using W&I insurance is to get around a situation where they would have to retain liability upon exit, so it provides for clean exit. If it is an insolvent situation or a distressed target situation, then the seller wouldn't even be in a position to give warranties. So, interestingly, the market has been expecting more distressed deals during the global pandemic, and synthetic warranty solutions, which often come together with the distressed target situation, have been advertised by the insurers, but this wave of insolvencies didn't really happen during the pandemic. However, we are always ready to service a bankruptcy situation by means of supporting the sale of an asset with the W&I policy. And
sorry, allow me to interrupt. Briefly interrupt.
Please.
You had mentioned a very important buzzword, Gergi, that not all of our listeners, viewers may be familiar with. You spoke about synthetic insurance. Maybe as this is a concept that is, I think, strikingly relevant and important, maybe you can elaborate a little bit more on what synthetic insurance means in the context of W&I insurance.
Thank you for the question. Of course, I agree that synthetic warranties is a nice buzzword, and the financial services industry likes to use its buzzwords for solutions which are more technical. So in this case, a synthetic set of warranties means a warranty set that has not been negotiated by the parties, either because the seller did not give warranties, did not want to give warranties, but the buyer looked into obtaining W&I insurance, or because the warranties couldn't apply to the target at all. So in these cases, an insurer can propose a set of warranties to the actual deal and provide its pricing as a package solution. This comes up in distressed solutions, and we are always happy to give more insights and know-hows into this aspect of W&I insurance. A synthetic set of warranties is also an applicable term when we are talking about excluded liability under the SPA, because there's no attachment point really. Because in the majority of cases, the parties are expected to negotiate the warranties, and the seller is often agreeing to at least a nominal liability cap. It can be €1, and we can insure it for 10 or even 100 million, but there is a liability cap. However, it is a synthetic situation, and it is a slightly differently drafted W&I policy when we are talking about seller exclusion of liability under the SPA. So that is also a synthetic warranty situation.
I mean, I find the concept very interesting insofar from a practical viewpoint, as very often, sometimes I mentioned deadlock situations in negotiations or situations that lead to unnecessarily prolonged situations. This is clearly the case when the one side seeks warranties that the other side is not willing to give. This is, and of course, there is several ifs and whens to be added from the insurer side, because it's not possible, and we come to that. Not any risk can be insured. We cannot wish the stars in this respect when we are in a transaction. But of course, also here, I think W&I insurance and a good insurer gives the possibility for the parties to be, I would say, happy at the end of the day, insofar as the seller does not have to give the warranty that he is unwilling to give, but the buyer gets the warranty that he wants to get. He gets it from the insurance. He doesn't get it from the seller. And that's the synthetic element then of the transaction. And you had briefly mentioned this, but I would again like to mention it. Also, the amounts, the caps of given warranties are subject to the same synthetic considerations, right? They can be, the insurance can give more in this respect than the seller is prepared to give at the end of the day. Of course, all is a question of money at the end of the day, because somebody has to pay for this luxury. But these are options and these are possibilities that I think make it possible to extend the scope for parties what to think about in a transaction. It broadens the field of possibilities to come to terms with the other party more efficient and more quickly.
Exactly. So it's not
to this interruption, György.
No, please. I mean, I think we all wanted this presentation to be more interactive. So thank you for adding to the interactivity of this presentation, and also for our listeners. Please never hesitate to interrupt us and ask questions by use of the chat function. So you are welcome to ask questions. And just referring to what Peter has said, I think it's also important to clarify who is who in this whole process, because we are doing this presentation with a prestigious law firm like Theiss, because obviously lawyers are managing the deal. They are drafting up the documents and they are setting the terms and conditions in stone, or at least on paper. So it is extremely important for us that lawyers are aware of the solutions that we offer. Now, a broker's role is to identify the risk and offer the solution, because the broker knows the insurers and the underwriters, because at the end of the day, a certain risk identified by the lawyers on the deal presented to the broker will have to end up with an insurer to find the solution. Now, 10 years ago, there were 3 insurers for the global market, maybe 4 or 5. But certainly today we operate with insurers in the number of 10, 20 insurers who look into risks from Central and Eastern Europe. And all of these insurers have different appetites. We present the same risk for all the markets and we get different feedback. It's the same product, but it applied differently. And this is where we help, because as brokers, we know the underwriters. We have the relationships with the insurers, and we can identify the solution and then tailor it to the actual deal. Just because of the interest in title insurance and how it works and familiarity of the real estate sector with title insurers, we agreed to provide a little bit of comparison. So title insurance usually follows the asset. It insures the entire asset value, and more importantly, it is also usually assignable. So we do it on a transaction, but it's the same insurance that can be applied in the next transaction. Whereas W&I insurance is SPA related, it's deal related, it's not assignable. It usually covers a basket and not the entire deal value. So if there is a future transaction, we have to do the W&I insurance again.
Maybe to briefly step in at this point again, you mentioned, of course, correctly that usually W&I is not assignable. Still, I think a way to speed up a transaction is the following, and I'm not saying that this is an assignment, but in a certain sense, it comes close to an assignment. Let's imagine that a seller has, it's urgent for a seller to sell an asset, and he knows maybe there is a competitive process, there's an auction process with various buyers. What the seller can do, and what is being done in some instances, is that the seller, so to say, pre-negotiates a W&I insurance and prepares a W&I package that can then be taken over, stepped in by the acquirer. I think this is related to as a seller-buyer flip in technical terms of W&I. It's not a technical assignment, but it's a pre-negotiated package that helps to shorten negotiation about warranties and indemnities, because the acquirer knows that the warranties that he will get at the end of the day are being insured under a W&I insurance, and the seller knows that he does not have to enter into individual negotiations with buyers all the time with respect of his product. So I think that is maybe a little bit of an addition of this topic to speak about non-assignment of W&I policies.
Yes, and thank you so much for this input. And sorry about jumping around a bit, but what you are saying is extremely relevant, because of course it is a non-assignable policy, and it's a lot about process, as you say. So insurance is not an overnight solution, as we are not agreeing on an SPA overnight. And insurance is not a replacement of the usual way of how we do the transaction. We just received a question from Mr. Matthias Drescher about how W&I insurer look at the due diligence report. Now, it's extremely important that W&I is not a replacement of due diligence. The buyer is very much expected to do their due diligence as they would do without insurance in place. Mr. Drescher also asked if or not there are any particular requirements the parties to the SPA should keep in mind. So in that respect, the SPA contains the warranties which are insured. So the way the parties are expected to negotiate the SPA is that the due diligence findings should be channeled into the SPA. Relevant warranties should relate to relevant points of well due diligence aspects of the business. Known issues can be priced by means of negotiating an indemnity. And the SPA can also reflect the liability limitation for the seller and the insurance requirement. There are, of course, various solutions how to reflect insurance in an SPA. We can insure an SPA that does not mention insurance at all. It's also possible that insurance is CP under the SPA, so it is specifically mentioned in the SPA, and it is made a requirement between the parties.
Mm-hmm. May I add a point here, maybe from a practical viewpoint, because I think this is really a crucial question that had been asked here. And there is situations, and I think it's really interesting because we see, I think, the product from various angles. Sometimes we see it from the seller side, from the buyer side. Sometimes we are also engaged as advisor to a W&I insurer in the course of its insurance process, where we act as advisor to the insurer. Now, what our assignment then will be, and it's a key assignment for us as legal advisors to the insurer, to look at the quality of the due diligence that had been performed, either in the course of how accurate the seller was when preparing a vendor due diligence report. That clearly is something, because the vendor DD report, when it's being disclosed, is, so to say, also part of the seller's due diligence. It's equivalent to the seller's due diligence in a technical sense. But what we will have to look at specifically is whether or not the acquirer did a thorough due diligence of the risks that he wants to have insured. And when we see, as legal, we will not double up the due diligence that had been performed. We will not, as legal advisor to the insurance company, to the W&I insurer, make another independent due diligence generally. But when we see that a risk has not been thoroughly due diligenced, what we will have to do, what we get is a so-called warranty spreadsheet from the insurer, and we give recommendations there in the course of the process. We will consider the risk as not or only partially insurable when it has not been due diligenced thoroughly, either by the vendor in his due diligence or by the seller. And I think, Gergi, it's also worth mentioning that there is a recent experience that we had in a transaction. It was a brief one, where it turned out that basically no due diligence had at all. Practically no parties had negotiated a catalog of reps and warranties, but there had not been a thorough vendor due diligence, nor had there been a buyer due diligence. Actually, parties had to have been sent back to the table for the purpose of possibly ensuring their transaction, to do their homework, and to carry out the proper due diligence, as far as I recollect. And that's, of course, a very frustrating experience, because, and that goes back to an issue that I had mentioned before, think about whether or not wanting to involve W&I at an early point of time, because when you are of the viewpoint, and some parties are, that to have a full-fledged catalog of reps and warranties are a substitute for a due diligence, right? You don't carry out the due diligence. You just have the other party warrant that your expectations are correct. Well, this may work, of course, but this will lead to a transaction that cannot be insured. That's, I think, a very important aspect about what this question has to. Yes, you have to do. W&I insurer looks closely at a due diligence report and is liable to do that. We, as legal advisors to the insurer, are then liable to have done a thorough job in this respect, and we will look at the report very carefully. Otherwise, the risk will not be insurable because maybe not all other, and when the due diligence, sometimes it leads to the fact that a due diligence has to be improved in the course of a transaction. That can also help. Interestingly, and that's my concluding remark about this, I think to involve W&I in a transaction really helps to improve the quality of a due diligence that has been carried out. And this is something I think that is really also in the interest of parties, that when they go into risks, they go into them knowingly and not by closing their eyes and just letting the other party warrant for something. That will not be insurable at the end of the day.
Thank you for this input. I mean, we have seen, we've been in these situations together, at least on one particular occasion. And I can agree with you. I mean, what is specific for the Central and Eastern Europe region is that often we see deals with only red flag report. We see, major findings report. We see situations with no reports at all, or situations where the parties only carry out a confirmatory due diligence. So they acquired. It was acquired 2 years ago, and now they just rely on the previous DD that was done 2-3 years before. Now all this is difficult for insurability. However, in my practice, we have done the impossible a few times, but this required a very intense participation in the deal by the broker, and this is where we have our unique Central and Eastern European offering, because we have the knowledge of a transactional lawyer, we have the knowledge of an underwriter, and finally a broker who can put this whole thing in context. And I do agree with you that I think the increased use of W&I insurance will also lead to less opacity on deals. In other words, we don't apply insurance because we want to make the deal less transparent. To the opposite, the more transparent the deal is, the better the insurability becomes, and the better the parties can rely on the benefits of the product. Now, I think we have mentioned a lot of things. What is also important, and we always have to emphasize, is that W&I insures against the unknown. And therefore, what is excluded is often relevant for a W&I policy. So, as you mentioned, inadequate due diligence would be an exclusion. A lack of disclosure is also something that leads to exclusions on the insurer's part. So, again, more transparency, better insurability. On the other hand, there are certain categories that are not really negotiable. So we can't really insure against fraud by the insured. In all jurisdictions, there's a prohibition on aimed at ensuring fines and penalties, and of course bribery, corruption are always excluded. There's an aspect that is also very important, and it also comes up on my deals, where there are other insurances available. Sometimes we start with W&I and we end up with an environmental policy. Sometimes we need to advise clients that there is a product liability insurance, or D&O can be a complementary cover for W&I, but that can be a question for another seminar maybe.
And maybe to maybe at this point briefly interrupt again, because I think it's particularly relevant for real estate. Some other and correct me, Gary, if I'm not aware of developments in the industry in this respect. An important category of risk that is not insurable under the W&I is construction defects. That's important for real estate transactions. So those cannot be insured. Nor is it possible to insure forward-looking statements, like, for instance, achieving certain revenue figures, profit expectations, etc. The leakage is something that is not insurable under W&I. So there is, I mean, these are absolutely correct, the broad categories of what is not insurable. But there is, I think, several, of course, factors that may be relevant that for which other solutions may have to be found in the context of a transaction, and where the expectation would be incorrect that any risk could be covered by, let's say, W&I plus title plus some other special product. But I think that's also your specialty, to advise about risks that are otherwise hardly insurable.
Yes, that is correct. I mean, that's the role of the broker. We are experienced with all lines of insurances. We do W&I on a daily basis. We have contacts in the industry to service other types of needs, and we are here to analyze and find analyze the deal and find the right solution. There may not be an insurance for everything, but at least we have experience with seeing a lot of the situations, so we can provide very early advice, and we are also precise and to the point in this question. I mean, it all depends on the transaction in the end.
Right, but for instance, I mean, tax, just to mention that tax is insurable. That's very important to know. Of course, one needs audited reports in order to maybe also at the same time destroy some hopes. In this respect, a certain level of precision will be needed also. But I think W&I is an instrument that can fairly cover a broad variety of risks that are inherent to and that are otherwise subject to representations and warranties in real estate transactions, be it a share deal or an asset deal.
Well, a tax is part of our coverage, and we can always do that.
Right.
So that is part of the solution.
Maybe let's move on. We don't have too much time left, basically. Let's move on, Gergi, to how the process in practice works. What the individual steps are to come to a W&I policy.
Yes, so the process is usually dependent on the underlying M&A process, where we have to deal with the dynamics of the transaction. So if you approach us at an early stage, there would be a situation where we are ready to do a kind of first approach on the risk. We can look, we sign an NDA, there's always a confidentiality requirement, and we can always reach out to the insurers on a no-name basis. So there is, this this aspect of the process. We usually start at an early stage of the transaction, and there is an opportunity for us to obtain all the deal documents. What we do here is we look at what's been presented as part of the parties' disclosure to start with. It also depends on whether we are approached by the seller or the buyer on a deal, but usually the process takes about 2 weeks. So we have to reach out to the insurers. We have to understand the deal. We have to find the right insurer for the deal. So from this perspective, it's a time-consuming process. As I said, we have to have access to all deal documents. So the deal has to be transparent, and we have to deal with it at an early stage to structure a good W&I policy. And there are certain specifics of the W&I process. The W&I process is free of charge in the beginning, i.e. we can obtain insurers' non-binding indications just by means of presenting the risk to them. The first cost element comes when the parties select the W&I insurer. Then, with the selected insurer, a so-called expense agreement needs to be put in place. This expense agreement usually covers the underwriting fee, which is probably 15,000-20,000 euro. It also depends on the actual case, but this is the first cost element. Now, reaching the expense agreement stage means that the parties already have a serious consideration about W&I insurance for their deal. And the expense agreement can also be drafted in a way that the seller and the buyer share the cost of insurance. Now, when we reach the expense agreement, it means that the underwriting starts. So the insurer will have access to all the documents of the deal. And this is when the underwriters first analyze this deal documentation that is presented to them. So the insurer will have access to all the documents, and then as a result of their underwriting, they will also ask their own questions relating to the deal. How well the deal was due diligenced, what is the level of disclosure on the deal, what is the what's the FPA negotiations like, are the typical questions the insurers ask as a result of their underwriting. And then there is usually an underwriting call, and following the underwriting call, the W&I insurance policy is finalized. So the whole process is actually quite time-consuming. As I said, it takes at least 2 weeks. But it still offers the commercial benefits of insuring a deal, and it provides for clean exit to the seller as well as increased protection for the buyer.
Mm-hmm. I see we have, on the one hand, I think we should also speak about cost also.
Yes.
But I see that we have 2 questions on the chat that I think we should be addressing briefly before moving to that. First question was that you had mentioned, Gary, that CE transactions may differ from the European standard. To what extent? I mean, that's a broad field, basically. I think that this question opens that would be clearly the topic not only of a seminar, but and of course, we would have to first define what the European standard is. So maybe I think we can postpone this question to maybe another seminar. But I think the concluding part of the question was whether you also what you would consider as major differences, and whether this also relates to synthetic insurance.
Yes, I think. Sorry, I was just looking at my watch. The major, I think I already mentioned this to some extent, because what we have to deal with here in the Central and Eastern Europe region is often a lower level of due diligence, or as I said before, a red flag DD, which is often enough for the parties on the local market, because they know the market environment, they know each other, they know the asset, and they think that only a red flag DD will be enough for the takeover, because that is what they are used to. On the other hand, this is perfectly fine for them, but it doesn't really make sense from an insurance perspective. Mm-hmm. And this is a difference that we often have to deal with in case of local clients, because local clients often still want to find an insurance solution where the level of documentation is not really up to insurability standards.
Mm-hmm. So insofar, synthetic insurance does not resolve this topic, right? This has nothing to do with this topic, with the question that you addressed. And I think it's fair to say that there is a conflict, of course, between a red flags due diligence and a red flags due diligence report and the insurability of a risk and a transaction. As I had mentioned before, and as you emphasized again, a thorough due diligence is a requirement to insure risks. So insofar, to save the money on the due diligence probably is not a helpful approach to make a transaction insurable at the end of the day.
No, it is not.
Insurance requires full due diligence and thorough due diligence.
Yes, and this is non-negotiable.
That's absolutely correct. Another question is a fundamental one that has been asked. Is it possible to actually insure an indemnity? Do you have any experience with successful coverage of any standard indemnity? That goes to the question, of course, that in several contracts, there is a distinction between the warranties and the indemnifications, right? Yes. And I think that's really an interesting one in the context of W&I.
Yes, and as the gentleman who asked this question, Mr. Kren, rightly pointed out, this is something that cannot be solved by the closing of a transaction. So what we have to deal with here is a known risk. And known risks are usually reflected in an SPA by means of an indemnity agreement, where after the closing, the seller would be indemnifying the buyer against the volume of losses coming out or resulting from this known risk situation. Where this is relating to W&I insurance is this is a special situation, and it is a known situation. So the standard W&I policy would exclude this.
That's a very important point to be aware of and to bear in mind again. So thank you.
Yes, and in that respect, the market can pick up these risks. So the way it works is that it is excluded under a standard W&I protection. However, it can be insured still, but in a different way, because an indemnity situation is usually limited to a cap. In a takeover situation, we know about the factual background for an indemnity, And the seller usually wants to minimize their exposure, whereas the buyer wants to increase the seller exposure. And this is where insurance can provide a solution. So up to a certain point, we cannot remove the liability from the seller. However, above this point, the insurance can cover the losses coming from the indemnity. This is what is usually called a special situation insurance. Mm-hmm. And there are different requirements for the insurability. And of course, there is a volume angle. So the quantum of the exposure has to be up to a certain standards, but we can look into it.
So this will be the topic of one of our next webinars then, special situation insurance.
Happy to do it.
Right. Maybe now to conclude, to come to an end, let's speak about deal volume and insurance cost, Gergi, for a moment. Is it worth the expenditure when you buy an apartment? Let's say, to use an extreme example, to take out W&I insurance? Or does it have to be a portfolio of shopping centers where it's worth to think about it? And what are the involved costs?
So we are talking about transactions and not only just investing into a flat, right? So, we are talking about transactions where lawyers are involved, where there are financial advisors and serious players engaged by both the seller and the buyer. So this means there has to be volume. What we usually say as benchmark is that the starting point for W&I insurance policy is about a deal which is in the range of 10 million euros. Because the minimum premiums applied for by W&I insurance usually make sense when we are talking about at least 10 million euros of limit of liability. On the other hand, there are transactional situations such as a distressed sale or or a transaction that involves a high number of sellers, where even a smaller transaction can justify the placement of insurance. As an extreme example, I had a transaction which was only 2 million euros worth. On the other hand, there were 90 sellers involved on the seller side. So the parties concluded that it's still worth insuring the transaction, and they paid 100,000 euros on a 2 million deal for insurance.
Mm-hmm. Right, and of course also the minimum premium. Yeah, I think this imposes kind of natural thresholds. Maybe one of the critical questions, and that may be the final one, Gergi, to be discussed in this webinar, that of course could be much longer, to discuss really everything, is do insurers pay when a risk materializes? How do insurers react? Is it kind of when you sign on a W&I policy, do you just take out a piece of paper that offers you comfort? How is the practical process working in reality when you have a claim and when you address your insurer and when you expect to be reimbursed by it?
Mm-hmm. So yes, I mean, there are instances where this type of insurance pays out. The industry standard is that 1 or 2 policies in 10 are affected by claims. So the claims ratio hits about 10-20% of all W&I insurance policies. The claims usually relate to the financial, tax, and compliance warranties, as well as material contracts. In case of operational entities, employees, intellectual property and litigation if applicable. On the other hand, the main feature of W&I insurance is that it covers financial loss. And a loss under a W&I policy is any amount of actual damages which the insured is contractually entitled to claim against the seller under the SPA. So whatever the buyer could claim from the seller in a post-closing situation is subject to a claims notification. A claims notification, again, it does not have formal requirements, but it's good to have a lawyer to work on such notification. So, in many cases, what we see is that the lawyers who worked on the underwriting do provide assistance in claims. And there has to be, of course, a notification on the claim, which warranties are affected. Now, for that reason, we usually advise clients to have as many warranties as possible under the SPA, because then a claim would have more attachment points. Whereas if we are, discussing a one-page warranty list, the attachment may or may not be successful, but it is less probable than if we have a good variety of warranties which are potentially affected by the claim. Mm-hmm. So first, attachment points under the warranty spreadsheet, and we also have to provide evidence on the quantum of the claim. Why are we claiming this? So there has to be evidence. How the factual background to the claim occurred. This also has to be considered as part of the claims notification. So there are a lot of factors. Claims are there, and we also I've seen a couple of claims also in this practice. So we can advise clients on how to put their claims together.
Yeah. For those who are interested, I think AIG and Aon, they publish claim statistics basically on an almost yearly basis, where it is shown which countries, how many claims, what the claim volume is, etc., etc. So that's quite useful to look at. What I can confirm is, from our experience, is that insurers are very pragmatic about claims. There is what falls away is kind of this already mentioned emotion factor, that there may already be between seller and buyer when there is no intermediary involved. Claims are looked at very pragmatic, and it's not always necessary to litigate to have a claim settled. So insurers, our experiences, approach this quite pragmatic and without emotion. So the disputes to be carried out may be more pragmatic than the ones that are between the parties about possible claims. You had mentioned an important point that I would want to re-emphasize. I think to take out W&I insurance and to have the possibility to raise claims under the policy also removes, I would say, litigation risk that may otherwise be given on a level playing ground in a transaction when you have to choose a forum for a transaction that may not be convenient. And where there is little experience to deal with certain claims. To deal before the district court of the province XYZ to have to deal before the provincial court in the district court of province XYZ in the country ABC may be less convenient than to have to go to arbitration with an insurer. So I think that the question of choice of forum may also lead to the fact that it could be interesting to take out a W&I policy. But I think we are almost 17 minutes across our, I would say, ideal finishing line at 1 p.m. It's been really interesting to have this discussion with you, Gergi, and I hope it was interesting for viewers and listeners also to our webinar. Should you be interested in getting the slides, please let us know. With the consent of Gergi, we will be sending out the slides to the ones of you who are interested. And should you have any follow-up questions, of course, should you need specific advice or guidance, Gergi's contact detail as well as mine are at the on the kind of last page of our presentation here. And we wish to thank you very, very much for your attending this webinar.
Thank you so much.
Goodbye and have a good afternoon.
Thank you for the possibility, and I hope this was another aspect of fruitful cooperation. Thank you
very much, Gergi. Goodbye.
Thank you. Bye.